Hi everyone. Welcome to Young Guide Podcast. Before we begin, for those of you who are new to the Young Guide Podcast, this is a place where two main content areas are shared. The first is personal finance management skills, and the second is the life experiences. Electric vehicle startups are struggling to compete with Tesla. Since Tesla's success in the electric car market, many startups have joined the race. However, it seems that new electric vehicle startups are facing major difficulties, as they are constantly hit hard by Tesla with their advanced technology and modern production lines. Tesla has continuously lowered its prices to attract the majority of customers. Why is it that only Tesla can do this? Let's find out with Young Guide in this podcast. The challenge for startups when copying Tesla. Tesla was founded in 2003 and is a famous American electric car company headquartered in Houston, Texas. It is regarded as a leader in the EV revolution, providing the first electric car with a range comparable to gasoline-powered cars and a large charging infrastructure. This electric giant also leads innovation with software updates via the internet, a huge touchscreen, keyless entry, and hands-free driving. Tesla's empire is so vast that in 2021, it was valued at over $1 trillion, surpassing other long-established traditional car manufacturers. And even when mentioning the noun electric car, everyone immediately thinks of Tesla. Electric vehicle startups once hoped to defeat Tesla but seem to have forgotten the first rule in business and product sales: selling products at a higher price than their production cost. New startups that join the market and lack funds, such as Rivian, founded in 2009, or Lucid, founded in 2007, are still losing a lot of money on each car they sell. In the context of slow production acceleration, this puts these companies at risk of having to seek more funding from shareholders. Bloomberg believes that companies like these should consider approaches similar to Fisker's outsourcing production to reduce risks. This strategy will also satisfy investors. This is why both Rivian and Lucid are following a different strategy from Fisker, as they are trying to imitate Tesla's vertical integration plan, producing their own vehicles and developing Tesla's core technology. This has attracted a large number of private investors, at least in the early stages, and their vehicles have also received good reviews. However, their losses increased last year due to the high cost of producing cars and their inability to increase prices to offset these costs. In fact, a year ago, Tesla CEO Elon Musk warned that Rivian would witness negative gross margins. But in this case, it seems that he has accurately calculated Rivian's production costs, which are 3 times higher than their revenue in 2022, resulting in a net loss of $3.1 billion. While Lucid's annual net loss is $1 billion after accounting for research, sales, and administrative expenses. Both companies reported operating losses of $6.9 billion and $2.6 billion, respectively. To make matters worse, 2022 was a difficult year to efficiently operate a new car factory. A shortage of components and supply chain disruptions recently caused production lines to come to a halt. Rising interest rates and declining demand from customers have made it even more challenging for some electric car companies to purchase expensive materials to balance their financial books. Taking advantage of this situation, Tesla has reduced prices of some of its models by up to 30%. Tesla's move has sparked mixed reactions among investors and Wall Street experts. Some believe that this policy is aimed at tackling weakening demand, while others assert that Tesla is deliberately trying to crush its competitors by sacrificing some of its profits. It is worth noting that Tesla customers who purchase discounted cars are eligible for a $7,500 federal tax credit. Analysts have emphasized the importance of this price cut and stated that it may have a profound impact not only on Tesla's brand but also on the increasingly competitive electric car market. Some even believe that this could be the first shot fired in a price war, given that electric car manufacturers are struggling to secure enough raw materials to get these vehicles on the road. Jessica Caldwell, the CEO of the car buying website Edmunds, said that Tesla's latest price cut reflects a significant shift in the electric car market in 2023. Where a wave of new electric car options will join the market, but most manufacturers will produce them in limited quantities due to material shortages. Thus, Tesla is positioning itself to attract consumers who do not want to wait by doing something that all car buyers love: offering discounts. Faced with this, other electric car manufacturers are also lowering their prices, albeit to a lesser extent. This move has already led them into a crisis. For example, electric car company Nikola warned that it could run out of money in the next 12 months. The more electric trucks they sell, the more they will lose in the short term. Nikola predicts that the gross profit margin, which is the profit after subtracting costs, will be negative from 75% to 95% in 2023, a terribly poor level. An exception until now is perhaps Fisker, by outsourcing the production of their startup. They can produce more than 40,000 cars in 2023, which is also the first year of production, and achieve a gross profit margin of 12%. The confidence that Fisker has obtained has helped the company's stock increase by 30%, another challenge for Tesla and Elon Musk. In the context of electric car manufacturers trying their best to catch up with Tesla, it seems that they have just been dealt a blow by Elon Musk's latest goal of continuing to reduce the production costs of new generation cars by up to 50% in the coming years. In fact, analysts estimate that the best-selling models of Tesla also have a cost advantage of thousands of dollars over competitors. And these competitors are making every effort to narrow the gap. We have a way to produce a smaller car with costs and difficulty reduced by half compared to the Model 3, Elon Musk said. Tesla CEO achieved the cost reduction target through a combination of vertical integration, factory automation, reduced components, and other measures. Elon has not yet disclosed specific numbers or when these cost-reduced models will be announced. However, if successful, analysts believe it will help Tesla fulfill its long-standing promise of a $25,000 electric car without destroying its leading position in the industry or their double-digit profit margins, according to Caresoft Global, a company specializing in dissecting different car models for cost comparisons. The estimated cost advantage of Tesla's small, versatile Model Y sports car is at least $3,000 compared to equivalent models from competitors, not including the battery. Even if Elon Musk succeeds in achieving a 50% reduction in production costs, industry observers say any significant effort towards that goal is meaningful. At a conference in February, Rod Blosh, an analyst at Wolfe Research, told Ford CEO Jim Farley that in the company's survey of 100 investors, 92% said they did not think traditional car manufacturers could match Tesla in terms of costs. And of course, for new companies entering the electric car industry, what will they use to compete on an equal footing with the giant Tesla? Discounts are not always good. Elon Musk has been discounting Tesla cars in China for several months. Initially, this helped Tesla sell more cars, but subsequent price reductions did not receive as positive a response as previous adjustments. Automotive analyst Adam Jonas said Tesla's price cuts have begun a broader price reduction in the industry as consumers wait for prices to drop. But not all Tesla customers are satisfied. Some who purchased cars just a few weeks or months ago requested a refund for the price difference. Tesla's sales discounts have also caused some negative reactions in the US market. Similar to China, where Tesla buyers feel deceived when they were not informed of the manufacturer's plans to reduce car prices. They requested free self-driving software or free charging at stations to compensate. Despite the mixed reactions, Tesla cars continue to surprise in terms of depreciation. Tesla recently reduced the price of the sedan Model S by $5,000 and the SUV Model S by $10,000 in early March 2023, which customers have become accustomed to waiting for. Morgan Stanley evaluates that the prolonged price war could make consumers more hesitant in buying cars, as a comprehensive price war will encourage consumers to stand and wait for even deeper discounts. For Tesla, continuously reducing prices will make early buyers feel cheated, while later buyers will have a wait-and-see attitude because who knows when this giant discount will happen again? Young Guide would like to end today's sharing here. If you find these contents helpful, please share them with your friends and family. Also, as usual, YouTube algorithms prioritize videos with more likes, so if you like this video, please click on the like button to help us reach more people. Thank you for your support and please stay tuned. Thanks for watching.